Okay, good afternoon, everyone, and welcome to this session of our London Financial Regulation Seminar. And today we have our guest speaker, William Allen, who will be talking about coronavirus, government support in times of crisis. And Bill Allen is currently a visitor at the National Institute for Economic and Social Research. He worked for many years at the Bank of England from 1972 to 2004 and was also seconded to the Bank for International Settlements from 1978 to 1980 and was a member of the EU Monetary Committee that preceded the advent of monetary union in Europe from 1994 to 1998. He has also worked in private sector and for the IMF, and he has written extensively on monetary subjects. Today, in his presentation, he's going to compare the financing of government deficits and the issues of debt sustainability following the pandemic, and he's going to compare this current instance of government support, coronavirus, fiscal policy, debt management, and inflation, with the financing of the two world wars in the 20th century. And in the light of those experiences, discuss what the economic and financial after effects of the pandemic might be, a very important and topical subject, as well as a proposal of his own. So thanking Bill very much for being with us this afternoon. I will now give the word to him, reminding everyone that if you have any questions, once that Bill finishes his presentation, we will have Q&A for around half an hour, and my colleague Katrien and myself will be in charge of organizing this Q&A, addressing the questions to Bill Allen. So the slides are being now shared, and the floor is all yours. Thank you very much for being with us today.
Thank you, Rosa, for inviting me to speak, and thank you all for tuning in. I hope you can all hear me. The coronavirus pandemic is sometimes compared to a war, and I think that as regards its financial effects, that's an apt comparison. So that's why I thought it would be interesting to compare the financing of the coronavirus deficit with the financing of the two world wars of the 20th century in Britain. And as Rosa said, I'm going to conclude with a proposal which I think would mitigate one of the current risks to the public finances. Now, the graph shows the ratio of government debt to GDP since 1900. You can see that the increases are normally quite steep and sudden, and the decreases are gradual and slow. You can see the effect of the two world wars and of the financial crisis. You can see a big reduction between the end of the Second World War and about 1990, which was mainly attributable to inflation and to economic growth, to some degree from budget stringency in the late 1940s. But bear in mind too that the graph goes into the future. The path of the debt to GDP ratio to the right of the vertical line shows the forecasts that the Office for Budget Responsibility has produced in the light of the recent budget, and they run up to the year 2025-26. Now, here are some numbers. The first and most obvious point is, if you look at the first column, that the coronavirus deficit is only a fraction of the size of the deficits incurred in either world war. It's 32% of GDP, according to the OBR's forecasts, compared to over 100% in each war. And the government debt to GDP ratio at the end of the episode will be lower. It'll be 109% as forecast, compared to actually nearly 250% at the end of the Second World War. But there's another important difference, namely quantitative easing. The quantitative easing involves the Bank of England buying gilts, buying fixed interest government securities in exchange for interest-bearing balances credited to the reserve balance accounts of the commercial banks and the Bank of England. So the gilts that it buys are held in a company called the Asset Purchase Facility, which is in turn financed by a variable interest rate loan from the Bank of England. And the Bank of England, the Asset Purchase Facility is fully indemnified by the Treasury, and any profits or losses that accrue to the Treasury. So it's quantitative easing is exactly the same as if the gilts had been bought by the Treasury itself. So what's happened is that the government debt in the hands of the public has been switched to a large extent from fixed interest gilts with maturities of 5, 10, 20 or 30 years to deposits in the Bank of England, which bear interest at variable rates, which could change at any time. Now, currently, the Asset Purchase Facility holds £770 billion worth of gilts, which is about 40% of the amount in issue. Coincidentally, it's also about 40% of GDP. When the current programme of gilt purchases is completed, the Asset Purchase Facility will have £875 billion of gilts. In other words, there's about 100 billion to go before the programme's finished. So, in effect, the quantitative easing programme has radically shortened the maturity of the government's debt by moving 40% plus of it to overnight form. So, if you look at the last column of the last but one column of the table on the slide, you can see that the short-term interest-bearing government debt to GDP ratio at the end of the war or pandemic is actually higher than it was at the end of the First World War, though not as high as it was at the end of the Second World War. It's 43% compared to 26% in 1919 and 61% in 1946. Now, if you look forward by several years, you see that after the two world wars, the short-term interest-bearing government debt to GDP ratio fell by a lot. After the First World War, it fell from 26% in 1919 to 16% in 1925, and after the Second World War, from 61% in 1946 to 32% in 1952. If you look at the forecasts made by the OBR, and if you assume that the current QE program will be completed, but that after that there won't be any more QE, nor will there be any unwinding, which is a kind of neutral assumption, you find that in 2026, the short-term interest-bearing government debt to GDP ratio will be 37%. In other words, more than a comparable period after the end of either World War. And that's what you see in the last column. Now, let me look a bit more closely at what happened after the First World War. Before the war in 1913, the national debt had been very small, having been reduced steadily through the 19th century after the Napoleonic Wars. And borrowing during the war was very expensive for reasons which are very interesting, but which I haven't got time to explore. So the government's debt interest costs went up from about 2% of GDP before the war to about 8% immediately afterwards. That was a colossal increase. But nevertheless, the government adhered strictly to the doctrine of the balanced budget, which was a kind of integral part of the monetary orthodoxy of the time. They got back to a balanced budget in 1920 to 21, as you can see. And And that was part of the program of restoring sterling to the gold standard at the same parity as it had been at before the war. So monetary policy and fiscal policy were both very restrictive in the aftermath of the First World War. As you can see from the bigger table, the increase in borrowing during the war was enormous. It was more than 100% of GDP. And you can see from the smaller table that about 3/4 of it was in the form of gilts and savings certificates, in other words, long-term borrowing. About 1/4 was in short-term form, either in Treasury bills or ways and means advances. And that was regarded as dangerously inflationary, according to the beliefs of the time. Now, there was a post-war boom which began in 1919, which was halted by a very sudden and severe tightening of monetary policy, which brought on a period of deflation and unemployment. Deflation was what they actually wanted, because there had been a lot of inflation during the war, and they wanted to reduce the price level so as to get back on the gold standard. Now, if I quote from the history of that period written by Susan Howson, she wrote in her book, for about a year after the war, conditions were tailor-made for a boom. There was a large budget deficit, money was cheap and plentiful, and there were large quantities of short-term government debt in the hands of the public, especially the banks, as a result of wartime government finance. Now, she was talking about 1919, of course, but what she said applies quite accurately to the present situation. But after the war, because they were anxious about the amount of short-term government debt, they embarked on a program of lengthening the maturity of the government debt. And as you can see, it worked. If you look at the figures for 1925 in the right-hand column of the bigger table, the amount of Treasury bills and the amount of ways and means advances had fallen in all by about 700 million. And the ratio of short-term government debt to GDP was down by 10 percentage points, from 26% to 16%. Now let's move on to the Second World War. And there you can see that post-war fiscal policy was even tighter than it had been after the First War. That was because the government was by that time doing Keynesian demand management, and they figured out that to contain demand, they needed to have a budget surplus. And that's what they did. They had budget surpluses of around 4% of GDP for 3 consecutive years until 1950, when the Korean War broke out and military spending went up. Interest rates were kept low, and the economy grew very fast, and inflation began, notwithstanding the tight fiscal policy. As to debt management, in the Second World War, the government and the Bank of England regarded what had happened in the First World War as having been pretty disastrous, and were determined to borrow more cheaply. And they achieved that by announcing upper limits to the interest rates they would be willing to pay to borrow at different maturities. In other words, they employed what's now called yield curve control. And they were able to do that because they could impose extensive controls over private borrowing and private financial transactions in general. During the war, 60% of their domestic borrowing was in the form of either gilts or national savings, in other words, in quite long-term form, and 40% was short-term borrowing. But the amount of borrowing was so enormous that at the end of the war, the ratio of short-term government debt to GDP was 61%. Now, after the war, the government persisted for a while with yield curve control. In fact, they reduced the level of yields that they were willing to pay in late 1945. They were afraid of secular stagnation, and they wanted to keep interest rates, the government's interest costs down. But it didn't last long because investors regarded 2.5%, which was the new level of long-term yields, as unreasonably low and wouldn't buy 2.5% long-term bonds. So rather than allow the debt to become even more weighted towards the short end, the government abandoned yield curve control and allowed long yields in the market to rise. That went on, or that situation with long-term interest rates drifting upwards, but short-term interest rates held down, persisted until the general election of 1951. But after the Conservative victory in that election, the maturity of the government debt was lengthened by an operation in which the banks were forced to convert part of their Treasury bill holdings, quite a big part of their Treasury bill holdings, into 1, 2, and 3 year gilts. In that way, the government restrained the bank's ability to create credit and at the same time reduced the sensitivity of the budget to variations in short-term interest rates. In other words, they kind of insured themselves against rising short-term interest rates. Now, moving on to where we are now, this graph sets out the government's fiscal plans as set out in the budget earlier this month, and the forecasts produced by the OBR. As you can see, the deficit goes on. Of course, it reduces in size, but it levels out at about 3% of GDP. The output gap is forecast to be eliminated by 2025-26, which is the last year of the forecast. And the inflation target of 2% has been renewed for the coming financial year. I think maybe that's the most important feature of the budget, because it affirms that the government will not use the inflation tax to finance the deficit. So the debt GDP ratio, which is currently just over 100%, is forecast to go up to nearly 110% in 2024, and then to fall back to 103.8% in 2026. Now, the forecast that the OBR has produced is based on market interest rates as at the 5th of February. They have to make some kind of assumption, and that's when they were doing the forecast. So that's the date they chose. But since then, the yield curve has risen by something of the order of 30 basis points. And the OBR, quite rightly, draw attention in their report to the sensitivity of the public finances to changes in interest rates. And they comment that the increase in interest rates that's happened since we closed our forecast on the 5th of February would already add 6.3 billion to the interest bill in 2025-26, published in the document. All else equal, that would be enough to put underlying debt on a rising path relative to GDP in every year of the forecast. So what that's telling you is that the public finances are on the kind of borderline between being sustainable and unsustainable, because a rising debt to GDP ratio is an unsustainable path. But they did qualify their statement with the words "all else equal," and that's important, because if the rise in interest rates was paralleled by an equal improvement in the outlook for economic growth, the path of debt to GDP ratio wouldn't increase. But interest rates are at historically low levels, even after the rise since the 5th of February. There's an obvious risk that they will rise relative to output growth. So the OBR is warning that if that happened, even a modest increase in interest rates would be enough to imperil the sustainability of the public finances. Now, I should add that the government's fully aware of that. Mr. Sunak emphasised it in his evidence to the House of Commons Treasury Committee after the budget. Now, I want to look at the numbers relating to the pandemic and post-pandemic recovery. The big table shows the evolution of the public debt from 2019 until now, and the projections to 2026, which are based partly on the OBR forecasts and partly on my assumptions about quantitative easing. In other words, that the current program is completed but not reversed, and there isn't any further quantitative easing after the current program. As you can see from the smaller table, on that assumption, then, well, actually not on that assumption, in any case, so far, up to the end of this current year, only about a quarter of the deficit in the 2 years, 20 to 22, has been financed by long-term borrowing. The rest has been financed by deposits in the Bank of England. And that implies that the public finances are unusually sensitive to variations in short-term interest rates. If the Monetary Policy Committee were obliged to raise short-term interest rates to contain a threat to the inflation target, then the budget deficit would rise immediately by about 0.4% of GDP for a 1% rate hike. Now, the debt to GDP ratio is already forecast to be rising for the next 3 years. And if rates were to be high, then the government would be pressed to adjust the primary deficit so as to assure debt sustainability. They would have to do that by cutting non-interest spending or by raising taxes. And it's pretty obvious that the government would find that prospect extremely unattractive. Otherwise, they would have done it in the budget, which we've just seen. So, to summarise all that, the objective after the First World War was to restore the world of yesterday, as Stefan Zweig called it. There was a post-war boom, which was abruptly checked by high interest rates. The objective of restoring the gold standard meant deliberately aiming for deflation, and high interest rates were a feature of the both wartime and the post-war period. The budget was balanced despite enormous increases in debt interest, and there was a rigorous control of spending, and there was a policy of mopping up short-term government debt. After the Second World War, in many respects, it was very different. They persisted with low interest rates, in other words, negative real rates, supported by financial repression. That was motivated by a fear of secular stagnation. They used controls and rationing to contain demand for quite a long time after the war. Fiscal policy was very tight, and the mopping up of short-term government debt took place, though it didn't begin until 1951. And there was a tolerance of inflation, which was the main feature of the reduction in the debt to GDP ratio after the war. What do we know about the post-coronavirus period? Well, low interest rates have been assumed by the OBR because they took what they saw in the market. There is, again, a fear of secular stagnation. The inflation target has been retained unchanged. Budget deficits are projected to continue, and the public finances are barely sustainable, even at low interest rates. there is no plan in the post-coronavirus period to mop up the short-term government debt that has been created. So there are some questions about post-coronavirus fiscal policy. Firstly, are the interest rates assumed in the budget realistic? Those are the ones as at the 5th of February. Well, firstly, market rates have gone up since then. Secondly, at some point, quantitative easing will have to stop, both here and I think in the USA, maybe also in the euro area, who knows. But it must be expected that that will lead to a rise in bond yields at any rate. Secular stagnation, or the fear of secular stagnation, is certainly one reason why rates are very low now. That was that same fear was there after the Second World War and turned out to be completely mistaken. Goodhart and Pradhan have produced good reasons based on demographics and deglobalization for thinking that actually inflationary pressures will come back. And thirdly, there is an enormous program of green investment which is being or is going to be undertaken, which makes it seem highly unlikely that investment opportunities will be lacking. There are other questions too about the budget, like, for example, whether the provision for health and railways is adequate, and whether the forecast of tax receipts is realistic. And then there are the interest rate related risks, which I've talked about already. The OBR themselves draw attention to the sensitivity of the budget to interest rates. And the retention of the inflation target means that the Monetary Policy Committee has got no choice but to hike short-term interest rates if the threat of inflation increases. They have got some discretion about the timing of achieving the inflation target, but they haven't got any discretion about whether to aim for it or not. So the proposal that I want to expose is one that would reduce the interest rate risk to the public finances. It's based on the premise that there is a risk that the inflation target will conflict with the planned fiscal policy, because the interest cost of the commercial bank's reserve balances created by QE would rise immediately if the MPC hiked interest rates. And as I explained earlier, if that happened, unless expected growth rose in parallel, there would need to be fiscal adjustments to the primary budget balance to maintain the belief in debt sustainability. Now, the risk could be reduced by a swap of reserve balances for gilts with fixed interest rates. And the obvious way to do that is to sell gilts to the banks in exchange for their reserve balances. To fit in with the maturity preferences of the banks, the gilts would have to be short or medium in maturity. And the amounts involved would have to be well over 500 billion. So it's far too much for an auction. So it would have to be, there have to be some kind of compulsion attached to it, or a major negotiation. That would mean that the interest rate risk would be transferred from the government to the banks. There's no reason why the bank shouldn't be allowed to sell the gilts in the market if they wanted to. As I explained, the total issues would need to be well over 500 billion. I don't know exactly how much. And that would have to be explored. And you would have to expect that gilt yields would rise So there would be some tightening of monetary conditions, but the extent of the rise would be contained because there's some degree of international arbitrage in government securities markets, and you would expect inflows out of, for example, US Treasuries or maybe European government securities into gilts. The quantitative easing program, which I assume would still go on, would provide some support. And I think too that it would be useful and sensible for the Bank of England to offer to act as a market maker in short and medium gilts for a period to protect financial stability and in particular to ensure that the dealers in government securities were able to continue in business. The proposed swap wouldn't affect the bank's positions under the liquidity coverage ratio requirement because gilts count as a high quality liquid asset along with balances in the Bank of England. And if the Bank of England was offering to make a market, then the liquidity would be quite genuine. As I explained, this would be revisiting the compulsory serial funding operation of 1951, which aimed to mop up surplus liquidity after the Second World War and ensure the government from some degree against rising interest rates and rising debt service costs. It's certainly preferable, I think, to an alternative which was suggested by Charles Goodhart and Adair Turner in giving evidence to the House of Lords Economic Affairs Committee, where they predicted that the government would react to a rise in short-term interest rates by stopping paying interest on some or all of the commercial bank's reserve balances. But that seems to me to be not feasible because it would put all the burden on the banks. The burden might become very heavy indeed, and the banks are not in any case very profitable, so it would be crippling for them. All this is set out in a paper which came out on Friday, which is issued by the National Institute called Managing the Fiscal Risk of Higher Interest Rates. So let me stop there and invite people to comment or ask questions. I'd be happy to answer questions as best I can. I'd certainly be interested in comments. Thank you very much.
Let me start in my privilege as chair of this. On the last point that you mentioned, you said that, simply not paying interest on a large chunk of bank reserves would put a burden on the shoulders of the bank, though we will obviously solve the fiscal problem at a stroke. So the question I wanted to ask you is with regard to this failed fear of secular stagnation. You said that after World War II, one of the architects of the programs, including the proposals that gave rise to the IMF, John Maynard Keynes, didn't anticipate post-war inflation, but post-war inflation came with a vengeance. So one of the points that has been made, and you said you referred to the rise in market rates since the budget was announced, is the return of inflation and whether or not the central banks are failing to anticipate the return of inflation, since that remains their primary mandate. And I was mentioning that earlier today, Charles Goodhart and Manus Pradhan were again presenting their book, and they were saying how those of us that did not live through the inflationary periods of the 1970s do not recall the strain and the struggle that it took to really combat those inflationary pressures and the problems that were associated at the time, which were not so easy, with international debt problems, severe recession, de facto insolvent banks, and debt ratios now are much greater than in the 1970s. So can you talk a little bit again about the possible return of inflation and the effects on the QE program, and also the effects on the mandate of the Bank of England, or perhaps the revision to the mandate of the Bank of England in the light of debt sustainability?
Yes, I think that everything looked absolutely fine before the financial crisis. And there was part of the sort of the independence of central banks established the idea that the central banks would keep out of fiscal policy and the governments would keep out of monetary policy. And that worked very well indeed. But one reason why it worked was that nearly all of the government's debt was medium or long term. There were very, very few Treasury bills around. And so when the Bank of England put up short-term interest rates, it didn't make any difference to the budget deficit. So there was no risk of any there was no conflict. The government could sit back, let the Bank of England move short-term interest rates up and down. Of course, it affected mortgage holders and so on. But it didn't impact on the government. So the Treasury representative who attended the meetings of the Monetary Policy Committee could sit there happily listening to what they were saying and not get worried about the conclusions. That all changed with quantitative easing, or it began to change with quantitative easing. And as the amount of quantitative easing gradually increased, the impact of interest rate decisions on the budget gradually got bigger. Of course, that hasn't become an issue because short-term interest rates have remained very low. But I think, looking back on it, the quantitative easing has been extended to such a degree that it's compromised the ability of the Bank of England to fulfill its mandate without seriously embarrassing the government. Now, what can happen? One thing that can happen is that the Bank of England can stress that it isn't going to be trigger happy about raising short-term interest rates. And have said that. They've said they're going to wait until there are clear signs that inflation is going up before they tighten monetary policy. That's okay, but as I recall when I was there, we always felt that if you waited for clear signs of inflation turning up before you tightened monetary policy, you were too late.
Absolutely.
Maybe that isn't the case anymore because inflation expectations arguably are more stable than they were then. But nobody can really know. At least you can't tell from comparing indexed bond yields with unindexed bond yields, because unindexed bond yields have been suppressed by QE. If there wasn't any QE, they would be higher. Indexed bond yields might not, because the QE program doesn't include indexed bonds. So that there you might see that inflation expectations are actually higher than they appear to be. Who knows? But anyway, that's one thing that could happen. The Bank of England can reassure people that it's not going to be trigger happy. What else could happen? Well, the government could change the mandate of the MPC, but it hasn't done. It had a chance and it didn't take it. The other thing that can happen is that the government can overrule a decision of the MPC to raise interest rates. That could happen, but if it did happen, it would have to be made public, and it would be pretty inflammatory because it would make it clear that there was a difference of opinion between the Bank of England and the government, or maybe not a difference of opinion, but a change in priorities on the part of the government. That's certainly how it would be interpreted. So that's a pretty desperate measure. And the Treasury must have thought about that and decided that it's a risk they are willing to take rather than raise the inflation target.
Yeah, that's definitely one of the challenges that we have as we move into a different, possibly inflationary environment and possible revision to the mandate of the Bank of England. That's certainly something that, we're again glazing into a crystal ball into what may happen in the next few years. So do we have now any questions from the group? Otherwise, I have more questions, but any other questions that you want to put in the chat room or you want to raise yourself now? Katrin?
Thanks, Bill, a lot for the presentation. I have a question regarding what you said about, so your proposal is to sort of basically push the risk towards banks, the interest rate risk towards banks by selling them the gilts. So because those gilts are not taken into account in their requirements and they're considered safe, you say we're not pushing them in any sort of bad position there, but I'm just not sure how that happens, because as I see it, you're just going to sort of shift the risk, at least the interest risk, from the government to banks. And I mean, they're systemically important institutions. So when that risk becomes reality, I mean, they're going to be bailed out, and then you just boomerang that risk back onto the government's balance sheet. Unless I misunderstand, but I'm just wondering how this sort of shifting of risks deletes the risk, I guess.
Well, it's a good point. And of course, it doesn't delete it. I mean, I guess what would happen would be this, that the banks, in any case, manage their interest rate risk very carefully. And if the government dumps a whole lot of new interest rate risk on them, they will try to unload it into the market. So you would have a shift in the yield curve, and the price of the risk would rise. And that would be the cost, if you like, of the government buying that amount of insurance. There's a question then about how much of the cost is borne by the government and how much do they manage to shift onto the banks. And that would have to be settled, I suppose, in some kind of negotiation between the government and the banks. But I think you're quite right. The banks wouldn't wouldn't just accept the risk. They would try to hedge it in whatever ways were available to them. And that would probably involve a price change.
Thank you very much. Do we have any other question from the audience that wants to ask? Either write it here in the chat room or ask directly. If not, let me ask you the next question, which I found it really interesting looking at the figures that you presented to us today, as well as the paper that has just been published by the National Institute of Economic and Social Research, which, by the way, I will make available to anyone that has attended today's presentation and want to have a copy. And that has to do with a little bit the future of QE, because what you have said is that is supposing that the current program, does not continue. So can you talk a little bit about the future of QE and the unwinding of the program in the light of the numbers that you have presented?
Yeah. I mean, personally, I think that QE has gone as far as it should do, and maybe a bit further, precisely because of the point about the sensitivity of the government budget to interest rate changes. I think it would have been desirable to start unwinding QE some years ago, if only so that you could use it again if needed. They did actually start unwinding it in the United States, and they made some progress until they ran into a problem in autumn 2019, when the repo market started to malfunction. Exactly what the causes of that malfunctioning were, I don't think are completely clear to me, but at any rate, they decided that reserve balances had got as low as they reasonably could, and so they terminated the quantitative tightening sometime in autumn 2019, and of course now they've started quantitative easing again. I think there was a big debate in the United States about whether the Fed's balance sheet should go on growing, or should be shrunk back to a much smaller size. Personally, I'm on the side of the much smaller size of the argument because of the reasons I've given. How you would unwind QE gradually, I think, is very difficult. If you were, the softest way of doing it is simply to stop reinvesting the coupon payments and the redemption payments that you get in the market. And in that way, the amount of gilts in the portfolio would gradually fall as the redemptions proceed. But that would take 40 or 50 years to complete because some of the gilts are very long indeed. So if you wanted to do it more quickly, then you go into the market as a seller. And it seems to me that if you were doing that, then you would have two sellers in the market. You'd have the DMO selling on behalf of the Treasury and the Bank of England selling on behalf of reversing quantitative easing. And that would just be kind of a mess. So a better way of doing it would be to find a way of transferring the gilts to the DMO and ask them to sell them gradually alongside their regular funding program, so as to absorb the excess reserve balances gradually. How gradually, I think, would depend on a judgment as to how much the market could absorb in any particular time. And it might not be possible to do what the DMO do now, which is to set out fairly precisely a program of sales at the beginning of each year and stick to it. They would have to some extent, feel their way and sell more in good market conditions and less in bad market conditions. So it would be a complicated and difficult operation, but maybe not impossible. But what I'm suggesting here is that it should be short-circuited by doing a very big amount at the short end in one go.
Yeah. When you were now talking about obviously the difficult issues that rise ahead, and you mentioned also in your presentation issues of potential instability in the markets, Mohamed El-Erian in some contributions in the Financial Times has been talking about almost the addiction of the market to the central bank QE and a kind of codependency between the markets and the central banks. So what do you think about that, and also the possible financial risk of vulnerabilities in financial markets because of this supposed addiction?
I think it's a real problem. At the moment, as I understand, there was a paper by Francis Breeden where he estimated the cost of having the DMO sell gilts and then the Bank of England buy them, as opposed to just doing nothing. And as I remember, the cost came in at about 50 basis points. So the 50 basis points is enough to support a small army of gilt traders who bid in auctions at the DMO and then sell the gilts back to the Bank of England a week or so later. That will stop when QE stops, and the dealers who bid in auctions will suddenly lose the one reliable source of investor demand that they have had up to now. So they'll be taking a much bigger risk when they bid in auctions. Now, they're already pretty nervous about risks because the amount of gilts that they can take onto their books is limited by the leverage ratio. That all these dealers are banks. In any case, the banks are not very profitable, so that they're rather kind of less tolerant of losses than they might have been in more prosperous times. So that it may well be that the banks would demand a bigger premium to bid in auctions. In other words, the price concession that you make for when you sell a chunk of bonds at one go will get bigger, because the risk to the dealers of underwriting the auction is bigger. It happened already some years ago before this QE, the latest QE got going, and the DMO have very wisely reacted by having more auctions, but of smaller amounts, like feeding babies. You give them a little and often. And they also introduced a post-auction option facility, which gave the dealers flexibility to take more gilts after the auction if they wanted to at the same price. So in other words, they became somewhat more sensitive to the market in their auctions. I think they might have to go further in that direction, maybe by having even smaller auctions and even more of them. So it's kind of going back a bit towards the system of cap sales that prevailed before the Big Bang in 1986. In other words, instead of announcing the quantity and letting the market determine the price, you go back to a system where, in the short term at any rate, you are to some degree managing the price and letting the market determine the quantity. There's a kind of spectrum, and you'll be moving along the spectrum towards price fixing and away from quantity fixing. I think that will be inevitable.
Mm-hmm. We have a question, Brandon Davies, and I have also another question written to me. Brandon, you want to ask your question, or you want me to read it? Brandon?
Hi, can you hear me?
Yes, I can now.
Oh, okay, great. My question was actually based on some research I did as the Treasurer of Barclays when I was looking at the unwind of what caused inflation after the Second World War and into the 1970s, or really the 1970s. And one of the interesting things that struck me at the time was that actually the giving of long-dated gilts to the banks, and long-dated gilts on Barclays' balance sheets actually exceeded its commercial loans up until the early 70s. But we unwound those balances and pushed them into basically commercial lending. That altered our interest rate risk profile because the commercial lending to individuals and to companies was short-term. It increased our credit risk, which is something we had to learn a lot about at the time. It increased our credit risk, but it also improved economic growth because it pushed it into commercial operations, and the economy flourished as a result. So I think my take from that in that research was, if you've got huge reserves, swap them for gilts. Don't pay any interest on the reserves above the level, and I sort this problem out. Don't pay on the level that exceeds the liquidity and payments requirements of commercial banks, and then let the commercial banks sort out the problem, because one, they will, because it's in their commercial interest to do so, and secondly, it will massively reduce this other problem that you get, which the previous questioner brought up, of codependency. And codependency seems to me to be almost like a suicide pact between the central bank and the commercial banking system. It seems to me to be an awful thing to do. You don't want commercial banks holding huge amounts of government debt.
Oh, well, the trouble is that to get their reserve balances down, you've got to sell them something.
Gilts, yeah.
Yeah,
Yeah, gilts, absolutely, fixed rate gilts. Yeah. And then they will sell the fixed rate gilts and move them into commercial lending. Move the proceeds into commercial lending, which is exactly what you want them to do. And it's not, in my view, it's not the central bank that can sort this out, it's commercial banks.
Well, I think the central bank got to, because the central bank controls the total of reserve balances.
Yeah, but it controls the price of them. But by altering the actual price that it pays on those reserves, and by swapping them for gilts, the banks won't want to hold reserves above the level necessary for payments and liquidity purposes.
There's another complication, which is the liquidity coverage ratio.
Well, the reserves have been taken out of that. At the moment, there was an ordinance, I can't remember which one it was, I've got it on my notes, but I mean, they've been taken out of that. They have in the US as well, because of this sort of technical issue. Obviously, if they hold gilts, it would come back into it, and so you'd have to feed the gilts in, I suspect, or suspend the ratio, and just take gilts out of the ratio as well. But given that the direction of travel will be for those banks to effectively swap the gilts for commercial lending, the commercial lending would then fall back into the ratio, and they'd have to manage it along with all the other ratios they have to manage.
Well, there are two things. There's the leverage ratio, which I think you're right about. It doesn't include deposits in the central bank.
No,
the liquidity coverage ratio does. So that
the LCR does, yeah.
And that locks them into holding either balances in the central bank or government debt.
No, not in, no. The LCR, you have to hold a certain amount of government debt, absolutely.
Yeah.
Because that's the difference between the need for a short-term liquidity and the giving of it. It's the ins and the outs, but so the net balance has to be in gilts. But that's not a huge number. I mean, that's not going to cause massive problems.
Is it not? I thought it was.
No, it exists as a huge number, but it's not in itself. It's not a number you have to hold. You can run that down by moving into commercial. You haven't got the commercial balances to require this level of reserve balances, or you would have. I mean, 800 billion would translate into an enormous balance sheet by the commercial banks, and none of them are growing their balance sheets at those sort of rates.
No, but I thought that their gilts and treasury bills was something like reserve balances, gilts and treasury bills was something like, gilts and treasury bills was something like 400 billion. I mean, I don't know. I need to look at the numbers again.
Yeah, and I would as well. I agree with you. But my experience of, which is a little cloudy these days, but my experience of managing it was that this was something that we did manage pretty well, because basically post Second World War, and particularly in the 1970s, the Bank of England had effectively handed us the problem.
Yeah.
And actually, we'd done a pretty good job of managing it, which was out of gilts and into commercial lending.
Yeah.
And it worked very well from our point of view because it massively reduced our interest rate risk, which was the big thing we were facing in those 70s, from holding these very large gilt portfolios, which obviously then were the swap for the reserves. I mean, I have some reservations about how this is working anyway, and I'm not going to bore you with that. But this particular point strikes me as it's easier to give the problem easier. It's more constructive to give the problem to the commercial banks than it is to try and think the Bank of England has or the Treasury has to solve it. I think the commercial banks can help a lot in solving this problem because that's exactly what they did after World War II.
Yep.
That's an interesting idea, Brandon. There is one more question. Katrina, if you want to read it, we got it into the chat room.
Yes, sure. So you refer to the independence of the Bank of England as an arrangement to separate the domain of monetary policy and fiscal policy, but isn't quantitative easing a mechanism of monetary financing?
Well, the answer is yes. and it confuses the neat separation that previously existed between monetary and fiscal policy. I think arguably it compromises the independence of the Bank of England, because in order to do quantitative easing, they need a financial indemnity from the Treasury, which means that they can't use their policy instrument unless the Treasury agrees. So, yeah, I think it has blurred the demarcation line between monetary and fiscal policy, and that's just a fact. And it would be as well if it were adequately recognised.
Well, that's a very interesting final conclusion, and of what has been a fascinating presentation for me and for everyone. This is recorded, so we will pass the recording to you, Bill, if you want to forward it to anyone else.
Thank you very much.
As to any of the participants today. And Brandon and Bill, if you want to continue the interesting discussion with further numbers, the three of us can continue to exchange on this point. But conscious that we have reached the end of the presentation, unless there is any other pressing issue from anyone in the chat room, and you can just raise your hand. I will otherwise, together with my colleague Katrien and Christine of our events team, thank very much Bill for really a fascinating presentation and a paper attached to it, which I will distribute to all the participants. And thanks also for the questions, which were, very interesting and in a way open-ended. Some of them raise more questions than actually give answers, which is good. That's what proper academic debate and independent academic debate is supposed to do. So on behalf also of CCLS and the London Financial Regulation Seminar, thank you very much for this very provocative and interesting presentation.
Thank you very much.